And welcome everybody to tonight's webinar. We're going to be discussing how to control your risk. Now, before we get into the actual webinar, as usual, the risk disclaimer. So please take a moment to read through that. That's long enough. All right, so what we're going to discuss today is I'll introduce myself shortly, just so you have an idea of who's talking. And then we're going to get into risk management, and we're going to talk about different facets of it. We're going to talk about knowing your limitations, and this has to do with several different factors. We'll get into that a bit more. We're going to talk about exposure. We're going to look at risk and reward ratios and how to implement those and calculate them. And then we'll look at trade management, so how to actually manage your trades. And after all of that, we will go into the Q&A for those at the live webinar, where you can just fire away and the floor is yours. Obviously, that part won't be in the YouTube recording for those that are looking. So we'll be happy to have you on a live webinar next time. All right, so let's carry on. So about me, who am I? Well, my name is Mike Rotink. I'm Dutch. I live in Greece with my wife and kid and a small dog. I studied international business studies through Cambridge program in the Netherlands. And during this period, I stumbled upon the financial trading markets. And like most, I just kind of went in there half-minded. Sounded like fun, so I started an account. Didn't work out too well. Then the second account, I thought I'd take a bit more serious by looking at, who was doing well. But obviously, then you run into these YouTube videos, these self-proclaimed gurus and stuff like that. Obviously, that didn't work out. So that was account number 2. And then the third account, I basically started from myself. And like most of you, struggle with a lot of little things that now seem very easy and stupid that I did. But that's the learning curve. I stuck with it, and eventually, fast forward 15 years, that account helped me understand how to do it. So I added funds to it, and that's basically been profitable on a yearly basis for the last 10 years straight or so. Now that brings me to what do I do? So out of that, obviously, I achieved my goals that I wanted to do with retail trading, and I wanted to try and pass on the knowledge that I built up over that experience to see how can I help others to avoid some of the beginner mistakes I did. And that is for one thing that I do these webinars for the last 5 years now, where it's freely available for you all to basically jump in and hopefully I can, in the short hour that I get, point out a few things. Obviously, there's mentoring that I do on my side. And recently, I have transitioned also into the financial market of financial advisory, where I'm currently working on my licensing and, really looking at offshore investing and stuff like that. That's me in a nutshell. So yeah, moving on. So with risk management, okay, so first we'll look at knowing your limitations, exposure, and risk and reward, and then we'll go into the actual next part, which is the trade management. So let's talk about knowing your limitations. So capital is one of those things, right? The amount of money that you have that kind of determines what you can and can't trade. I often get the questions like, well, Mike, if I want to start my live account, how much should I start with? Well, first of all, the more the better, because unfortunately in the financial industry, and especially in trading, money makes money. The more you have, the less risk you take, because you have options. And the less money you have, the harder it is. A good example of that is if I give you 10 euros, right, or $10, whatever your currency may be, and I tell you to get me 10% return on investment, it's really hard because you have very, very limited options of making that 10 euros work for you, if any. The best thing you can do is probably flip some item, right? Buy something and then flip it, right? That is your options. But if I give you $1 million and tell you to get 10%, the door is much wider. You have so many different options, and you don't have to do one thing. You have several different options to work with. So getting that 10% is a lot easier, probably even more. But how do you bridge that gap? right? And retail trading is a part of that, that opened that door for everybody where they can have access to actual trading and the financial industry with a reasonably low amount of investment. The average starting account is ranges between 500 and 1500 euros. So in dollars, that'd be like 400 to like $1,100, something like that. That's the range. That is the average. Obviously, there's exceptions there, but we're looking at the average. So usually I try to explain that even though if you go for the average, so let's take 1,000 as a flat amount, there are some limitations with that. And one of those things is that it's really difficult in that kind of capital to build up a portfolio of trades that run simultaneously. So a lot of people, what they do is they end up trading one thing at a time or multiple trades on the same thing at the same time, which is a pretty bad way of doing things. And this is why if you don't have any more, right, you need to understand that you need to set realistic expectations on what you can and can't achieve. One of the things that I run into, what I hear, is people think that they can invest 1,000 and in the end of the year have $10,000. Now, it's not like it's impossible because it has happened. There's people that walked away with $500,000 with only investing a few hundred. But it's extremely risky. You're basically doing a more risky approach than taking the same €1,000, going to the casino and throw everything on either red or black 10 times in a row, and you have to win them. And just literally go all in constantly and just double over and over. But you can understand that the risk level that you need to take in order to make this work has zero room for a mistake. You make one mistake, it's over. Like you get into a dip where you just can't crawl out of. And there are many, many traders out there, starting traders that make that mistake. They have $500 account to $1,000 account. They blow it up. They make a second, a third, a fourth, a fifth, and they keep putting that money in, expecting different results by doing the same thing. But it's also the goals that they set for themselves, right? If you think with retail trading 5% is enough, then you're undercutting yourself. Yes, it's more than inflation, and it would be better than leaving at the bank. Absolutely, because leaving money in the bank is the dumbest thing you can do from a financial point of view. When you look at, I want to make 300% at the end of the year, that's not realistic either. So what is realistic? To be fair, it is pretty easy to get between 20 and 50% return on investment on a yearly basis consistently once you've learned how to trade consistently. And what we're discussing tonight is basically going to help you understand why that works in certain ways and how to look at those things. And one of the big things that you run into is lot sizes, right? All too often, I see people trade with a fixed stop loss or a fixed lot size, or both, right? So for instance, somebody trades euro US dollar and their stop loss is 20 pips always, no matter what the trade, where they go in. My stop loss is 20 pips because I trade on one mini lot and I want to risk $20, right? So that you get that quite often. And sometimes obviously they trade on a micro lot and every single trade they do is on a micro lot, no matter how big or small it is. And they wonder why they struggle getting anywhere. There's a reason for that. And we're going to look at variable lot sizes a little bit big on. I tried to put into the handouts for the webinar an Excel sheet that I prepared, but we'll go through it together. It's quite a bit of data, but we'll like run through it. And you will see that when you use a variable lot size, instead of going in a linear equation, you go into an exponential equation. When your account is doing well, you grow much faster. But when you have those inevitable losing streaks, which we all get, even when you have experience, right? You will have a bad month or a bad week or, you know, a string of bad trades. That happens. Like it's just, you know, whatever reason, you just, you know, keep hitting the plank and you just keep missing the nail. and you're not doing anything different than ever any time else. So this is when you need to. This is where our brain basically needs to make a shift, and that's a little bit harder. So until you've done that, you're going to have that little rut that you're in, and that's okay if you're controlling your risk. And lot sizes is one of those ways to really do that, right? So if you have 10 losing trades in a row, and let's say you use one micro lot, let's say we use one micro lot, then and you have a fixed stop loss of 20, you're going to lose 2, 2, 2, 2, 2, 2. So you're going to lose $20 over time. Now, if I use a percentage-based system and I use 3% of my account as a risk, then it doesn't matter. At first it's 30, but then it becomes 28, then it becomes 26, 25. So I'm risking more, but I'm risking 3% of my account and 3% of whatever the new 100% is. So you can understand as you go lower, you slow down. Now, in this particular scenario, you would start off with a higher amount of risk and end up with a lower amount of risk, right? And I'll show in the Excel sheet that'll become sense that you'll actually make more money by setting up, by learning yourself how to calculate every single trade with a variable lot size. But we'll get back to that in a little bit. Now, one thing that isn't in here that I do want to point out is your capital also determines what you can trade. Right? So if you have a $500 or $1,000 account, and I get this question all the time, should I trade gold or should I trade oil? The answer is no, you shouldn't. Because the way that you trade oil and gold is more long-term and it's a little bit different. And obviously the ranges in which these things move are vastly different than the majors, for instance. So generally speaking, when you have a small account between 500 and 1,000, I generally advise people to stick to the majors and the minors. And there are some exceptions on CFDs like the the FTSE 500, the Nikkei and stuff like that, which are fairly stable and they have a fairly decent range. Like you can dabble a little bit with that, but generally speaking, you want to just stick to the majors and minors. And when you get to 1,500 to 2,000, you can maybe start looking into actually adding a little bit more CFD levels. And then you go to 5,000 plus where you can actually start putting in oil, gold, long-term positions. You can start looking at adding a few daily stocks outside of the bigger ones. So the more volatile ones where you can grab a few things, do a day trade or two there. And that is how you diversify your portfolio, and exotics, obviously, from the currencies. Right. And this is how but you do one thing at a time and learn that thing inside out and then slowly progress onwards. But don't get too stuck on one thing because then you're waiting for something to happen that might not happen for a long time. And now your account is basically frozen. You basically try to find where the volatility is. We trade volatility. That's our lifeblood. It's the scary part, but it's also the only part that makes money. Where there's money moving, that's where you can make profit. The downside is obviously you can also lose money. That's why you need to have a certain approach. Okay, so let's take a little bit of a different look at things. So let's talk about exposure. So we need to make sure that when we're having a portfolio of trades, or any trade for that matter, we need to consider that what are the global influences that we can have on that can affect my trade. Now, these are influences that are outside of the normal fundamentals, right? So outside of the drivers and outside of economic news announcements, right? So your economic calendar. So any of you have an idea of what I could mean by a global influence, something that could happen and affect your trade? Who wants to take this one? Well, COVID, yeah, that's a very, very good point. Natural calamities is another one, yeah. Central bank news is usually pretty scheduled. A war, yeah, that would definitely affect the market. So yeah, so it's pretty good. But the most recent one is obviously COVID, right? That's a very, very clear. Nobody predicted COVID. And the market went AWOL when it started. Now it's recovered and things are starting to slow down. But we live in a completely different market now than pre-COVID. So this is things that you need to keep in mind when you're trading, right? The market may have shifted, certain habits may have changed, certain price levels that markets move at might have shifted. No, we don't know all the information. We're just simple retail traders, right? We're not massive. You don't have a massive team of 200 researchers feeding you all the information in a condensed form like they do at Goldman Sachs, right? It's literally you and an economic calendar and maybe Bloomberg. That's about it, right? Now, some of you may have access to investment reports, right? So, you get a little bit of more information, some expert stuff, but still, it is fairly speculative. So it's very important to understand how markets can be influenced like that. And how do you plan it in for your trades? Well, you don't, but the way that you do it, in a sense, is by having good risk management. Because the only thing you should care about in trading is controlling your downside, not how much money can I make. See, this is one of those mindset traps that people fall in. It's like, this trade can make me that much, and this trade can make me that much. And if I do this trade, it could be that much. The only time I think about that is, well, never. I couldn't care less. The only thing I care about is like, if I take this trade, what is my risk? That'll be that. Okay, what is my risk here, my risk there, my risk there? And then I couple that on, okay, how many of these things could be affected by the same thing at the same time? Now, COVID is an extreme case because it affected the world globally. But obviously, when you have, one of the things that's not an economic calendar would be, I don't know, presidents, right? In the time of Trump, for instance, for the US dollar was very fickle because there was always the question if the guy would tweet something stupid. And the market usually had some kind of reaction to it, depending on what it was. So you factor that in. It's like, okay, whenever I trade the US dollar, I need to keep in mind that it might shift just because somebody says something stupid or, starts a war somewhere. No, the same is everywhere else, right? In Europe, it could just be, I don't know, Britain all of a sudden decides to leave the EU. And then when you finally get the actual Brexit to happen, they never had anything properly in place. So a complete supply chain disruption. So the pound is heavily infected by that. But when you were trading the pound, you already knew that you were in Brexit. You already knew you were things like doing things, and you factored it in. Yeah, Ravinda had a good one. Like Elon Musk influencing crypto, right? Exactly, right? He says something, I'm really a fan of Dogecoin. Bomb. And Bitcoin just flies up. Oh, shit, Elon Musk is into crypto. But these are things that it come out of the blue, but you try to factor it in by having good risk control that if something happens against you, it doesn't cripple you. Now, the other part of exposure is obviously very simple. Well, don't have 10 trades on the euro, for instance. You have no idea how often I have people coming to for mentorship and they literally do exactly that. I see the euro is strong today, so I'm going to buy the euro. And then they buy the euro on every single pair. Or at the very least, all the majors. There's two problems with this. One, every single opposite currency has a different ratio to the euro, for one. And two, if anything happens to that euro, all your trades are screwed. Or all your trades go into the plus. But is this from a risk perspective a good move? Of course not. You're 100% exposed to euro. Your entire trade portfolio. What would be better is have up to 20%. So let's say you have 10 trades, 2 are related to euro, 2 are related to the dollar, 2 are related to pound, and 2 related to, I don't know, yen, or 1 yen and 1 Canadian dollar, something like that. And different mixes of that. Now then you go a bit further, right? Because if you would use a percentage system, let's say every single trade you take 3% risk of the account, You're now risking 30%, which means you have 70% more of capital to utilize, right? Now, for those that are in Europe, obviously we have the margin call thing at 30%, so you have to factor it in. So I wouldn't go over 50, which gives you a 30% down draw. You should never go over that point anyway. But so let's take 5 more trades. Okay, now we can look at, okay, well, let's see. We can take some CFDs, maybe some FTSE 500. We can take the Nikkei. And oh, I'm really liking Netflix at the moment, Zoom, and name something else. Now, unless you're trading stock directly where you have to buy the actual shares, which is a completely different way of trading them, because you can only trade by buying low and selling high, right? You can't sell because you need to buy them first. We have the benefit in CFDs that you can trade both directions. Doesn't matter. We are only trading a contract for price difference. Right? We're not buying actual stock. We're just guessing where the price is going. Right? So you can utilize these really good into your portfolio, and this gives you a completely different exposure level where you really spread out. And from a risk control point of view, this is a very stable way of doing that. Right? Does that make sense? It does. Okay. Okay, good. Right? So that in a nutshell is exposure, right? So let's talk about trading. So when we look at risk and reward ratio, you often run into is like, well, I should use 1 to 2, or is it 1 to 3, or is it 1 to 4? What's the rule? You need to be realistic about this ratio thing. Preferably, you want 1 to 3 at the very least. However, it is not always realistic that with your entry point and potential exit point, you can actually achieve that. Sometimes it's way more, and sometimes it's less. Sometimes you have to settle for 1 to 1.5 or 1 to 2. On average, if you count all your trades up, your ratio should be around 1 to 3. Right, then you're doing controlling your risk, preferably even higher than that. That's what you're aiming for, but it depends if you're day trading or swing trading, or right, depends on your trading technique as well, what you're comfortable with. Like scalping, you'll never get this because you'll be inverted, right? You'll be 5 to 1 instead of 1 to 5. But this is one of those things that you need to keep in mind. Now we're going to go to a chart in a bit, and well, I'll put a few things in point, and especially with a stop loss and how to calculate your ratios and your lot sizes. But before that, let's take a look at what is the difference between a variable lot size and your fixed lot size. Now, here's where things get a little bit hairy. Whoops. Here's where things get a little bit hairy. So we're going to go to an Excel sheet that I prepared. This is a lot of information. I tried to make it a handout in the trade. It doesn't work, but bear with me here. So in both scenarios, these are complete copies from each other, right? The trades are exactly the same. It's just to show the difference. Now in this scenario, it's a $1,000 account. Now this on the left, we're trading with a fixed loss size on a 70% win rate, and we're doing 20 trades. On the right side, we're doing $1,000. I'm using 3% of my account, and we have a 70% win rate. I know what some of you are saying. I don't have 70% win rate. Don't worry. We'll get to that in a minute. So, bar from looking at all this calculation stuff, in the end, over 650 pips profit, I make 650 pips. So I make $650, right? 0.1 is a mini lot. Right, everybody with me? It's not 0.01, it's 0.1. So 1 mini lot, which would be insanely risky because you have to have really low, but, well, not insanely. Depends on the stop losses. On this side, we're using 3%. So we factor, as you can see, the lot sizes are variable. Like here, we don't have to put it in because we know that whatever the results is the profit, right? Because the profit is literally just that times the mini lot, times 0.1, times 1. Here, we treat the lot size slightly different because we calculate it every single time. Right? And you end up with slightly more than here. But this is the profit side. And what I said was, I don't care about the profit side. I care about the losing side. So let's take a look at the losing side. Let's say we have the same scenario, the same trades, but we only win 45% of them. In the fixed, are you making profit with 45%? Yes, because your risk reward ratio is right. And we'll get back to that later, right? So here you made about 15%. Here you made 22%. But it's a very small sample size, right? If you look at it in a graph, I mean, it's only 20 trades, right? It's really not all that much. So let's do a little bit different. Let's say we have a 60% win rate on the same 20 trades. You get the same thing again, right? Here you make about 49%. Here you make 62%. And that's doable. In a small account, you can have a higher return on your investment because it's easier, because it's a percentage, right? $20 on 1,000 is completely different than $20 on 10,000. Make sense? But let's take a look at an actual long list where we actually suck at trading. What is this? That shouldn't be there. All right, so same accounts again. Client number one, we're trading at 1 mini lot, 0.1, fixed. We are only winning 30% of our trades, and we're doing 50 trades. Who can guess what happens here? He goes bust. It depends on the stop losses, but yeah, it's not going to end up very well. So here, we're down 485 pips. So we lose 485, which means basically we'll have a little bit more than half of our account left over. Good start. Good 50 trades. But now, I'm going to go to the other side of the spectrum. So let's do the same thing, but now we're going to use 33%, and we're going to still win 30%. It's the exact same copy of trades, by the way. And that's why I wanted to give it a handout. You can run through it yourself. But if we do that, I got this chat window in my way. Hold on. Right. You can see here, you get a completely different window. Now, in some cases, like, let me see. You see, like here, where we're losing, I lose 28 here, he loses 35, but he makes 60 back, and I only make back 54 on the same trade, right? Take profit of 60. However, look at my balance here. It's 945, and he's at 845. And if you keep extrapolating, I actually come back to past my investment point at some point. He never does. You keep going. And we recover a little bit at the end, but he ended up with minus 485, and I ended with minus 135. I only lost 13.5% of my total account over 50 trades with a 30% win rate. You'd literally have to throw a dart at the board and be worse than that outcome. You could literally open a chart and just blindly click open something 50 times in a row and get a better ratio. This is why I wanted to stress this. Right, so if your win rate, and this is where that comes from, if your win rate is 40% with a variable lot size system, you have a yearly profitable account. You don't need to win that much. I don't know why people think that. Yes, it'd be great if you can win 75% of your trades, because then you will literally skyrocket the account. But if you win 50% of your trades, so you lose one, you win one, with a risk reward ratio of an average of 1 to 3, with a percentage-based system, you win. It's that simple. You just win. And in a graph, you would look at something like this. So if we're taking a fixed losing, and this is on the 20 trades, this is the actual calculations here, these two, the winning and the trading. So if you're losing, right, you can see here where we have a little bit of a win at the start with a fixed, and then we just had this massive losing streak. And you can see you go from 150 to all the way down to 955. But when we use a percentage-based system, you see that I climb a little bit less at the start because I don't have these huge jumps. But in the long run, when I hit that losing streak, you can see how the curve is more flat. And I end up with 1,024 where he ends up negative. So I'm still winning. I'm still above my investment level. And here we're not. Now, if we're actually having a decent win rate, this is what your linear equation looks like. And this is what you actually get with a percentage. And this, as you go on further down the line, you always use 3% of your account, which means that the bigger the account starts to get, the bigger your lot size, the more profit you start to making. You grow exponentially over time. And always have the same control of risk. Yes, the numbers get bigger, and that's a little bit scary. You know, when you start with doing $10, $20, $30, $40 stop losses, and you eventually end up with $20,000 and $30,000, yeah, that's a bit different. But the percentage is the same thing, is relevant to your account at that time. Let's say 3,000, right? It's still 3% of 100, right? The percentage doesn't change. I really wanted to send you guys this sheet so you can really like play around with it, but we'll do that in a minute. I'm going to use this in a minute as well. Right, so that's variable lot sizes. Now let's take a look at what happens between fixed versus a moving stop loss. Now, what happens if I use a fixed stop loss at all times? What is one of the biggest problems that you think we're going to run into? Who wants to take a guess? Too short? Yeah, yeah. It's too short, yeah. You're going to run into that problem. Sometimes too much, but not often. Oh, what a beautiful answer, Rainer. Yeah, your stop loss is not adjusted in any way to either support or resistance. You're not factoring anything in. You're just literally taking a flat number. Which means that might work in, I don't know, Euro CHF that moves like, 4 pips a day. But it's not going to work in GBP JPY that moves 150 pips a day. Right? The second biggest problem you have is that it is not calculated for the average daily ratio of every single particular pair that you're trading or commodity or whatever it is. You need to factor in the average daily ratio. If you're trading in an hour, the average daily ratio becomes the average hourly ratio, let's say. Right? You want to be outside of that range. And it should be outside of a resistance or support, depending on which direction you're taking. And if there is a trend line, you should be outside of that too. Because it has all freedom to move within that range. So that's why your entry points are so important. Okay. So moving stop loss, you adjust your stop loss according to where your entry point is going to be. And usually that means that your stop loss is going to be in a fixed location outside of resistance, outside of trend line, where it makes sense. And we're going to do that in the chart in a second. And outside, a range. But at the same time, it also means that your entry point becomes a bit more flexible, because your entry point, you can wait a little bit. Let's say you're doing price action and you're waiting for a morning star, right, to form. Then you wait for the candle to close, and the candle is a little bit bigger than you expected it to be, or it's an engulfing candle or whatever, something like that. And then the next candle you go in as per the rule would dictate, but you basically start a bit later than normal. Your stop loss will be at the same point as if you would have started at the start of the previous candle. Okay, so it is important to understand that you factor that in. And again, this is the same as the fixed lot size versus variable lot size. Moving stop losses, including trailing stops, or just a safer bet. Like, the reason I say trailing stops, even though trailing stops are obviously not optimal, because sometimes it will pull back a little bit more than it should, and then it hits your trailing stop and then it goes to take profit afterwards. I get that. But in most cases, you guys don't trade by sitting in front of your computer the entire day monitoring your trades. You're not a professional trader or a professional trader. You're not a dedicated retail trader that just does trading, right? You have your day jobs, and a lot of you are monitoring your trades on your phone and screwing with them, which you shouldn't do. The only thing your phone should be good for is to close a trade. That's it. You shouldn't even look at it. Now, let's actually set a little bit up. Let's take a little bit of a look at these things. So here I have the euro US dollar. It's on a 4-hour. Obviously, I didn't do any of the technical analysis. I didn't look at the fundamentals. We're just going to go in this fairly blind. So let's just do a really quick and dirty kind of technical analysis to kind of see where we're at. So obviously this is the current market. So we can see that there's a resistance somewhere over here, and that's probably why it's slowing down. No, I just want it thicker. Boom. Hopefully people can see that. Can we make it a color, a different color? Let's say, let's go with brownish. Right, I'm looking at minimal connection points, 1, 2, 3. There's a forced one there, so that's fine. And then there's one that it just broke through, like one. These are probably with wicks, if I'd have to guess. All right, let's put this one in. Here, no. Yeah, it's a soft resistance. It's probably there, but it's soft. Here's a pretty hard one. It got nipped here and then here twice. That's more recent. And this may have a wick on it. So let's find it out. I did. Wick. And here they all connect with wicks. And here they're all connected as well. And now wicking. All right, so let's say out of this trade, which will most likely pull back, right? We have a current resistance. Now let's take the next one after that is somewhere over here, I think. Let me just close this thing. Yeah, it does look like that. Somewhere like this. Well, if I would take a sell right now, should my stop loss be, whoops. Should my stop loss be here? Because that's the first next resistance. You think that's a stop loss? Who's going to take that one? This one? Or did I overlook something? No, I'm not cheating. I'm making you think. So there's another one somewhere over here. And if we look here, which is a little bit more recent, we have 1, 2, 3 points, and it actually held there. So there's actually one there, and then there's one a little bit above it. But more recent, more relevant to the current market is the one that we care about, right? So how do we care about that? Well, simple. If I now look at my trade and I go back to the candles and I zoom in a little bit, right? My stop loss shouldn't be like all the way out there. My stop loss is going to be here, but you wouldn't open the trade like this. We do know, okay, if my decision to go in now, we have the first rejection. This could, and it went negative, but then it went positive again. It's pretty high. There's good probability of a little bit of pullback. Now, if it does, then we're looking at, got it on the upside down again. I always do that. I don't know why. All right, so if we factor in Fibonacci, why is it not working with me? Sorry. So that's the current market. So what we want to do is, if it wants to pull back, now let's say the 38.2 sounds pretty sweet. It could actually go all the way back to the 61.8, but probably going to hang around here, right? Because we have that resistance there now, or support now, I guess. So what would be the idea is that, okay, if I decide to go in right now, which is right here, right? If I decide to go in here, green, where would my stop loss be? Would it be option 1, option 2, or that ridiculous thing we did earlier, option number 3? And the way I said it should already be an answer. Who's going to take it? 1, 2, or 3? 1, 2, or 3? Ooh, there's a lot of mix. Luckily, nobody says 3 though. So everybody was paying attention on that one. Okay, so let's discuss 1 and 2, because we have a mix of between I would do 1 and I would do 2. So what is the inherent problem with number 1 is that you are in a pushing market where it might need to go to the next one before it turns. So you're in that risk factor. And you need to factor that in with possible market movements. So you're thinking a little bit along the lines of a swing trade. Now, if you're a more secure trader, you could wait for price action. Or you could wait for this candle to close, see where it closes, which you should do before you open it anyway, but forget about that for a moment. And then, so let's say we'll go to 1 hour. So let's say, what is it, 47. So this closes in 13 minutes. We have an up, we have a down, but it's not engulfing. So yeah, what could it do? Well, in the next hour, we can decide what to do. In the 4-hour pendulum, it's got a pretty big jump. And if it opens a little bit like close to this, it can easily like have a little wick at the same distance as this and nip it and then pull down, or bump into this and then go down. It is more likely to do one of bump into this and go down than it is likely to just like shoot up, right, to this level. Is it going to go to this level? Yeah, probably, but it will have a pullback first, which I think most of you are by now seeing, that most markets have like this pullback. Like even here, where you go up, you pull back about 50% of it. So actually in this particular scenario, because you are pushing in, you would wait for this candle to close and then make your decision, but you would probably go for option number 2. Now it's a little bit bigger, but it's safer because there's 2 resistances in the way. It needs to break this one and then break this one to get there. And notice how I haven't thought about take profit because I couldn't care less. But based by rulings, it's going to go down, up, but then I would expect to pull back. We already looked at that. So you would take the safe bet and you go somewhere like here. Now the ratio wise, this looks fine. What is this? This is 28 to 55. Now, so this is 28. So let's do a scenario here. Let's see who's been paying attention. If I would use a fixed lot size, I would just lose, and I use a micro lot, let's say, I would risk $2.70. Okay. Now I have a $1,000 account, fresh, brand new. I haven't done anything on it yet. And my risk appetite I'll take slightly less than 3% because it is a little bit of a semi-swing. I'm predicting the turn before I see a confirmation price action. I'll take a 2%. What is my risk allowance? So how much can I risk? 2% of 1,000. Straight off the bat, 20. Yep, 20. Okay, so let's take a look. Our trade here has 28 pips. What lot size could I use on this trade? I don't use a calculator. Obviously you can if you want to. It's one way of doing it. But you're complicating it. Think simple. If I would take a mini lot on this trade, what would my risk be? 28. Okay. 28 is 8 over my budget. So let's take half. Well, if I take half of 28, that's 14. So I'm now under my budget. So it's between 0.5 and 1. So about 0.7. Slightly over, but that's okay. So this particular trade, if you have a $1,000 account and you take a 2% risk in this particular scenario, you trade this on 0.07. Sell. Done. You set up your stop loss, and now you drag your take profit to where you want. And there you go. Okay, I'm risking 20 to make 41. 16. Actually, I could have gone 0.8, but okay. A little bit less is okay. Right, and I have a good ratio. The trade is fine ratio-wise. So let's start with this. Come here, you little bastard. All right, so we have a trade set up. I went in. Like, if it actually gets stuck under this is basically the perfect entry point. But okay. You would probably wait for this candle. Like I said, you wait for the candle to close. You maybe wait for price action. You look at your indicators. You look at economic news. Da 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 da. But let's forget about that for a second. We're just doing it blind right now. So I have my trade set up. What is another step that I can do? Because I'm not going to be in front of my computer all the time. What is a very good step that I can make? Price alarm. I already have the trade open. You're all thinking about execution. Pending order is a way to execute the trade. Setting a price alarm would work as well, but what if you're at work? Okay, you get a price alarm, then what? You're going to open the trade on your phone. Whenever I mentor somebody, I tell them to delete the app from their phone. The worst idea you can ever have. Don't trade from your phone. Yes, there's the first one. It's not the ideal thing because manual moving your stop loss is the best, but you're at work or in an airplane or on a boat or a beach or in a bar. Market's moving. You're going to sit in the bar with your date or your wife or your pet canary or whatever it is and monitor your phone the whole time to see what the trade's doing? No, you're not. So yes, you would do a trailing stop. So let's take a look at this whole average daily ratio, hourly ratio, 4-hourly ratio, whatever. Now we have a particular funny situation here because we have these two massive candles, a third candle, and then a whole bunch of small ones. What would be the actual normal ratio? Well, that would be this. If we look at the rest as well, this is actually how the candles averagely move. But right now we have this acceleration. So we need to factor in what is roughly the pullback. The pullback is going to happen in these type of candles, not in this kind of candle, usually. Now, if it does happen in a candle like this, then I don't really care because it probably just goes straight here. But it's more for the, it goes here, then goes back, then goes here, then goes back, and then breaks through. So we factor in these candles. Now I usually get the question, how many? I usually just staple 12. I don't know why. That's just what I do. And I usually try to find where you have like a balance of reds and greens. Because when you're going down, you care about the greens more than you care about the reds. Red is in my benefit. It's when it pulls back up that I need to make sure that it doesn't go too far back up. Right? And it's been pretty consistent. Like all these candles similarly look around the same thing. So let's just factor a few in. And this would be the average 4-hour ratio. Now you factor in the wick as well. So this one is 31, 20, 15, 17. It's a pretty big wick. 35, 40, 20, 9, 20, 15, big one, 35-ish. So the range, what was the smallest one was 9, the biggest one was 40, the rest is all roughly between 25 and 30. All right, everybody agree with that? Okay, good. So we'll take it on the high end. We'll take the average is 35. So how do you factor that into your trailing stop? Well, that's very simple. I basically want a trailing stop of 35 pips plus a little bit of range extra. So let's say you have 35, just add 5 more. So 40 pip trailing stop should be outside the pullback range when it goes down and then back up a little bit. Unless it pulls back more than unusual, but at least your green trade won't turn into a red one. And remember the scenario of the fixed and variable lot sizes. If you do this, yes, you're going to have trades that go out at 0 or at a very small profit that screws up with your ratio. I know that. But in the long run, how many trades have you had that pull back, hit your stop loss, and then go to take profit? Wouldn't you rather gone out at 0 in that case? Or are you still worried about, well, I made the right choice, my stop loss was too short? The only thing you should care about is like, I screwed up. It should have never gone back into red. The drawdown is the initial part of the trade where you usually start negative and then it gets its movement. And you want to have your drawdown within the 20% range. If your account is in a drawdown, you have like 40% in drawdown, you're judging your entry points wrong. Right? So let's set up the trailing stop. And this is where people get tricky. They put this in 40 points. It says points, not pips. This is with a micro pip, that 5th digit. It is 4 pips, 4.5 pips, 5, 5.5. So we go to custom, we set 40 pips, so 400 points. Done. Now our trade is secure. Whatever happens, it either hits my stop loss or it hits my take profit or goes out somewhere in between. Don't care. I don't have to look at it anymore. I honestly don't care. I have dedicated my trade. I have analyzed and did the market research. There's no economic fun. I did all my technicals, my trend lines and everything else. And this was the decision I ended up making in combination with price action, in combination with my indicators. This is the decision I chose. This is the trade I chose. You now commit to it. And just let it go. Now, when your trade is 80% in the direction, no, Rainer, we just factor in, Rainer asked if the trailing stop is always bigger than the stop loss. No, it isn't. But we just factored in the average 4-hourly ratio. And when this trade starts going into the positive, it activates once the trade hits 40 pips in profit. So in this scenario, we're making 60 pip take profit. So once the trade hits right about here, the stop loss automatically goes to 0, and then it shouldn't pull back. But what you can do, if the candle goes down and closes underneath this, what is now a resistance, what is now a support, if it pulls back and it closes underneath, it becomes a resistance all of a sudden. So then you manually move it if you can. But if you can't, it's fine. Right? You can also say, okay, well, 40 does seem a little bit far because it's like 80% of the way already. Then you can say, okay, I'll make my trailing stop. I'll take a little bit of a risk on the average ratio, but I'll make it 300 instead, or 350, which was the exact ratio that we calculated. Because now, like 350 is just when it nips past that point. So if it wicks underneath this, it goes to 0. So at least that when it pulls back, gets rejected, and then shoots up, you have a 0 entry instead of a negative, like when it shoots back past your entry point and then into your stop loss. Because the worst thing to happen is that you go halfway to your take profit and then you hit your stop loss instead. And this is usually because you just don't move your stop loss in time. Manually would be better, but this is a way you can do it with trailing stop that is not ideal, because obviously manual would be better in a sense of micromanagement terms, but I keep in mind that people don't sit in front of their computer all day and do trading, because the only time they could do that is on the weekend, but the market's closed then. So it's more realistic to say do this. At least you'll be a lot safer and more consistent in your trading, because that's what I did and it worked for me. Emphasis on worked for me. Right. So let's tap into the last part. So entry and exit. So I did a whole webinar about this last week or the week before about entry and exit points and how to manage your trades in there. But what is very important is to understand your entry and your exit points, like we looked here. It's very important to understand what is going to be my entry and exit strategy and why do I want to be there. So let's take a look at the CAT CHF, for instance, and we have a whole bunch of stuff here. One of the ways that we can see this is that right now we're right on this little resistance line. So this would be a potential good entry point for it to bounce back here. But we have this small declining, we have a top here and a top here that is actually declining a little bit, which means that if the bottom now does the same thing and you get this, and I shouldn't use these two for that. Oh, bugger all. Yeah. Right, and you have your trend lines calculated, you do this little thing here, and then you set it up like this. Right, you do that little thing. Then if it goes here instead, then you know that this is probably a downwards channel that's starting to form instead of this horizontal stuff that's been happening. Probably keeps going horizontal, but beside the point. Let's say it does do that. We now know that there's a channel. That means that my entry point is going to be, ideally for a buy, if I do want to do a buy, going to be along this ratio, like right here. Because if you factor in the angle, somewhere over here. But most likely, it's going to stall out in here, right here, where it is right now. So then your entry point is this, and your exit point is going to be over here. Because you can factor in the average climb is, that one was slower, but that wasn't a downtrend. That was the same, that one's a bit steeper, and it's actually a bit scuffed. It's actually a little bit steeper than that. It's more like this. Yeah, so something like that. So it would look something like this or this if this one turns around. So this is your exit strategy. You don't want to push it for here because you know you're going to run into this potential channel that's forming, right? So this is with exit and entry. It's very important to do that part because it also gives you an idea on the duration of your trade. By looking at the average ratio and which it moves, like I did here, right? We can guess that, okay, if the trade would go along this path and my take profit is at this crossing point, then the trade should on average take 16 bars. We're looking at 1 hour, so 16 hours. If it goes down and the ratio is the same, it will probably be roughly 18 hours. I'll add 2 hours to it. 21. Right? So it'll be 21 hours. So that's a day trade. If this candle, current candle goes straight down, closes there, and then the next one opens up, and then there's an engulfing candle or a stick with a doji, and then you get price action, or maybe you're just using your indicators, whichever it may be. Right, same for any of the year. If you're doing weekly, daily, hourly, 4-hourly, it doesn't matter. Trading Bitcoin, please don't. Any of this, right? So, and I with this one as well. Let me just put that out. Like people are worried about. Okay, now wait, now go. No, wait. I need to do all of this so fast. No, this is an hour candle. You literally have an hour long to decide. This is not going to go anywhere anytime soon. It's not going to massively jump all of a sudden, unless there's an economic calendar event. In that case, you shouldn't be opening your trade just before it anyway. Right, so double check the economic calendar before you ever open a trade. So all your entry is important. That when you do your entry and exit, that you factor in what fundamental announcements come in between that could accelerate or decelerate or screw up my trade. You have to factor that in. Then the last one is portfolio of trades. We touched on this earlier with exposure. It's very important that you don't trade one thing at a time. Develop a portfolio of trades. And the way you do that is I use because this is just for the legacy effect. But what I have is like all euro pairs. I have 3 tabs for euro, and 3 for pound, and 3 for this, and 3 for that, 3 for that. And you do your analysis, and you don't have to do your analysis every day because I do top down from a week. So I do usually weekday, and then I execute on either 4 hours or hour, depending on the pair. But I want to know the big picture. Right? And this is the end of the day. There's a few hours left. It's unlikely that it's going to go all the way here today. It's more likely by the end of the day, people that are currently in this massive buy are going to start slutting it down. So that probably my sell is going to start pulling in, which is great. So, I made that decision now. For the week, it's probably, yeah, it's probably going to push a little bit, and then, it's probably going to do a little bit of a pullback, because in a week, if we would have done the analysis, we would have seen this. Might make sense. So then you would move your stop loss here instead, but then you would also be looking at a take profit over here. But we're not doing a week trade. We're doing a 1 hour trade, I think it was. And I made a mistake. That was it, I think. That doesn't matter. You can just close it. Right, so it's important to have a balance of portfolio trades, keeping in mind in capital, and your exposure, but it's better to prepare about 20 different trades that you're looking at that have potential entry points coming up or currently. And then you activate about 10 of them. And if you do a percentage system, which means you're risking 30% of the capital of your account, which means you have more than plenty of room to move around with, right? You have 10 trades. Now, unless you really screwed up, you would lose all 10, but generally you won't. Then on top of that, you can look at a different, if you have one or two trades, and this is a term we call marrying your position. If you have a trade that's kind of like stuck around entry or slightly in the negative, and it's just keep lingering on, and it's not moving, or it goes a little bit in green and back to minus and then back to green and then back to minus, basically moving sideways, then just close the trade. Take the small loss or small profit, whatever it may be, chuck it in the bin and replace it with one of the other 10 trades that you had pre-prepared. Don't marry your positions. I keep hammering on this. I had one guy come to me who had a position for Euro US dollar sell, buy, two positions for buy Euro US dollar with an entry point at 172. And he's still adamant that he will eventually go back to that price point. Oh, I can guarantee you he will never. Unless the dollar disappears. Like, that's the worst case of marrying your position I've ever seen. That position is like 8 years old. No, this is people that trade without a stop loss. They just open the position, and this is no risk management. Because if you would have risk management, you would never go from the euro to the dollar ratio of 173, which was 2004, and hold the position for over 10 years, hoping that it will go back. So yeah. Right. So make a good balance of portfolio, and if you have a smaller account, look at the majors and the minors first, and learn to trade with those before you start adding CFDs, with the exception of FTSE 500, Nikkei, and stuff like that. But don't go into individual stocks just yet. Right, and that covers all of that basically. Right. So for those that are leaving the webinar and for those that are watching the YouTube video, I hope you enjoyed this this presentation. I hope you learned something out of it. And yeah, for those that are watching the video, I would love to see you guys in the webinar at some point. Come interact with us and join us for the Q&A that we'll go into next. Thank you for watching, and see you next time.